I've heard all these excuses, Dave, like over the last, 4 years, AI was gonna like create this massive deflation. So I think it just kind of rides hot and we just kind of get used to this higher for longer. And it's gonna be like a 10-year higher inflation world like it was in the 70s.
John, we're here at your amazing Astoria Macro Summit here. A big part of the thesis I've gotten from you in the last couple months has been the inflation thesis. We've also seen called the debasement trade, which is a much more dramatic way of talking about it. Look, we're in this year, we've got gold as the best performing asset, silver's up 1 billion percent. What's driving this and how do you think this unwinds and how should investors be positioning?
We argued about 4 years ago that inflation would be structurally higher. If you look at like the 1980s episode, inflation had these waves, but it settled, it took 10 years for it to settle pre like 1970 levels. So the point is like we lived for 10 years with elevated inflation. So, inflation is one of these things where it's like once you take it out, the genie comes out of the bottle. It's like really hard to stuff it in. And most people don't want to like allocate money and part of the portfolio to like inflation fighting strategies. We think that basically like most of the core portfolio is in like tech, growth, long duration assets, which generally are like deflationary. So why not allocate a portion of your satellite position towards things like gold, energy, REITs, infrastructure, I would even argue crypto. So PPIs are like solution that kind of allocates across all these different sectors and could be used as like a standalone, piece to kind of hedge inflation. And the fund's up like 32% year to date.
So when people talk about fighting inflation, when I talk to advisors about fighting inflation, you end up with a couple of common answers. One tends to be, I just buy tips. What's wrong with that as an answer for how to deal with inflation? I mean, tips theoretically are supposed to immunize from from these effects.
Yeah, and Jeffrey Sherman just gave like his speech, and he argued that tips don't really work, and there's like a lot of pushback, which I don't like necessarily disagree with. I just think that like there's like a new way to sort of fight these inflations, and it is through these sectors like infrastructure, data centers, power plays, nuclear, uranium.
So why do those end up in an inflation portfolio? Like people talk about inflation protection around things like real assets, whether that's even real estate or whether it's gold or silver. Those are pretty traditional ways of responding to an inflationary impetus. Why are we now talking about data centers?
I think the idea is that like companies whose revenues are tied to actual physical assets. And I think that's the difference because so much of the S&P, as we know now, is tech, which is like, AI, robotics, cloud computing, like what have you. It's not like a tangible thing, right? But you can go to like Virginia and see like physical data centers that are going to power the AI trade, right? Or Wisconsin.
Got it. So it's a way of, in some ways, participating in what actually looks more like the momentum trade, the AI trade, the big tech trade, but on the portion of it that is actually real assets oriented. Yeah. Is that the way of thinking about it?
And that's just a portion of our PPI, I would say. I wouldn't say it's like, the majority, but the majority still very much is in like industrial stocks, could be like Caterpillar, Porsche, like these companies globally, along with like your traditional gold. The reason why we like gold so much is that it is a fixed supply asset, right? There's limited kind of gold in the world. And, if you look at 1970s when we had that big inflation, scare, like gold went up 5 times. So gold may be up only like 100% the last, 18 months. But like if history is any guide, like, gold can trend for very long periods of time.
And how do you match that against crypto? Because a lot of folks are comparing those two as the same trade, right? Is buying Bitcoin the same as buying gold right now?
I would say that, gold can be mined. It takes a lot longer, so it's fixed supply. But like crypto is like extremely fixed, at least like Bitcoin is, right? So there's only like 21 million coins.
But you include that in your overall
We do, yeah.
thesis.
Like we have right now like 9% allocated towards gold and 3% to crypto. And I think that's sort of like the right mix for like how we want to design like a complete solution to protect portfolios against elevated levels of inflation.
Talk to me a little bit about how this changes over time, because this fund's been around since 2021, something like that. It hasn't held data centers and
Right.
energy stocks all the way from the beginning. So you've adjusted over time as the market's adjusted. What are you looking at next? Like, what would you also be considering that's not quite in there yet? And what would it take for you to take something out?
Well, all good questions. I would say, right now, there's a lot of trend and momentum, which we respect that. So as kind of like traditional quant guys, we understand factors and, what it can do in a portfolio. I would say, when things get sort of rich, so like the whole fund is run through like a very quant dedicated process. So it's multi-factor. We're looking for, essentially at the end of the day, good growth companies that are high quality, that pay dividends, that are a little bit cheaper than the market, that rank good from a momentum standpoint, and that actually have like sensitivity to CPI. So there's like 20 different fundamental ratios. At the end of the day, like we do oblige by like the quant screen. So if like the data centers get like super expensive, it gets kicked out because something else, like everyone fights with one another in the quant code.
So it's not just blind faith.
No.
But does that apply also to the assets it's much more difficult to put a relative valuation on, like gold? I mean, is there a mark at which, like, well, geez, gold 5K, we're out. Like, I mean, how would you know enough is enough? As you pointed out in the 70s, from here the run in gold would be to 25,000 or something like that. So like, I can't imagine you'd be holding to 20,000.
Well, I think we probably, and I'm not like the compliance guy, but there may be a limit to how much we can keep of gold. But now at like 9%, we're not bumping up against any limit. But yeah, so that's the challenge with like gold and Bitcoin, is that you can't do like fundamental analysis to like say, okay, like it's overvalued. I would say in general, like gold is lowly correlated to stocks over like very long periods of time. So by that nature, we would want to allocate a portion to it. And since we were running the fund since 2021, we've always had gold. We just never like trimmed it. So it kind of got like, it got very high in the portfolio weight. You don't want to like fight trend, is kind of like the quant speak. So like we would just let it ride for now.
Got it. And then in terms of things that might be on the horizon that you'd be thinking about including, are there sectors or particular thematic plays where you can see the potential for this to be in the 2026 version of PPI?
Yeah. So I would say, if inflation starts to be more of a problem outside the US, like right now we are very much skewed in the US. But obviously inflation is like a global problem. We also don't have allocations to emerging markets just because the fund, we never set up like local IDs, let's say. But there's like, in theory, like because you have to be active, I think, in PPI, like your core could be passive, it could be like rules-based index, but something like, we heard Jeffrey Sherman today, like, mortgage-backed securities, commercial real estate, CMBS, like you gotta be active in that. And we think inflation, you should be active. But for now, we sort of have the fund's performing well, right? It's 4 stars. It's up 32%. Since we were running it, it's outperformed the S&P by 20%. It's negative 70% correlated to the S&P. So, I mean, sorry, not negatively correlated. It's 70% correlated to the S&P. It's fairly low, right? In a sort of world where cross-asset correlations are high. So I think for now, like it's good, but it is systematically quant checked like semi-annually. And then if stocks are materially deranked, like if it goes from like a one score, 2 score, like if it goes down to like 5, 6, 7, like then we have the ability to sort of kick it out.
Got it. Last question. So obviously your beliefs about inflation are important to whether you make and how much of an allocation you make to an inflation fighting strategy. We've been sitting here sticky around 3%. You're obviously paying a lot of attention to what's going on here. What would your baseline prediction be over the next 18 to 24 months for that inflation? Are we saying sticky? Are there deflationary components that could come about from an economic slowdown or an AI productivity boom? Or are there inflationary spikes that we haven't even thought of yet?
Well, I mean, the Fed's about to they have embarked on a rate cutting cycle. They cut 100 bips last year. They just cut 25. Chances are they're going to cut again. If anything, that's going to increase inflation more because it'll sort of increase demand.
Money in the flow, yeah.
If they're putting money back in the economy. I've heard all these excuses, Dave, like over the last 4 years, AI was going to like create this massive deflation. I mean, the point is like if we're at 3 to get it to 2, which is Fed mandate, they have to like kitchen sink the economy, which I don't think is like politically something that's going to happen with this administration. So I think it just kind of rides hot, and we just kind of get used to this like higher for longer, and it's going to be like a 10-year higher inflation world like it was in the 70s. So, and it's a big problem because I think inflation impacts, certain demographics more. Like if you own financial assets, you own a house, you own stocks, like you do sort of well because stocks do generally keep up with inflation. But you see like the lower income, the middle class, they really get hurt, right? So if people do have 401ks, I would say, look at your commodity funds, your real asset funds, because I do think that they can help you have a much more efficient, ride.
Oh, boy, I wish you were wrong about all this stuff, but I fear you're right. John, thanks so much.
Thank you, David.